Bitcoin just absorbed billions of dollars in institutional capital, and yet retail ownership is near multi-year lows. That raises a serious question. If Bitcoin was created as a peer-to-peer system for individuals, why does a growing percentage of the supply now sit on corporate balance sheets and inside exchange-traded funds? And more importantly, does that strengthen the network? Or does it quietly change what Bitcoin represents? Welcome to Mr. DJ Finance. Today, we are analyzing the claim that Wall Street is taking over Bitcoin, what the data actually shows, and where Michael Saylor fits into this shift. Let us get into it. Since the launch of spot Bitcoin ETFs in the United States, institutional inflows have crossed tens of billions of dollars. BlackRock's IBIT alone accumulated over 300,000 BTC within months of launch. When you combine that with holdings from Fidelity and other issuers, ETFs now control a meaningful percentage of liquid supply. At the same time, on-chain data shows that smaller wallet cohorts, typically associated with retail investors, have been net distributors during several rally periods. In simple terms, large entities are accumulating while smaller holders are taking profits or exiting. But here is where it gets critical. Bitcoin's fixed supply means that when long-term institutional buyers acquire coins and move them into cold custody, those coins become effectively illiquid. That reduces available market supply, which historically has amplified price movements during demand shocks. We saw a similar dynamic during previous cycles when long-term holders increased their share above 70% of circulating supply. Price volatility did not disappear, but supply constraints made upward moves more aggressive. Michael Saylor represents one of the most visible examples of this strategy. MicroStrategy began accumulating Bitcoin in 2020 and now holds over 190,000 BTC on its balance sheet, acquired at an average cost basis significantly below current market levels. Saylor's approach is not trading, it is treasury conversion. He views Bitcoin as a superior store of value compared to holding cash in a debasing monetary environment. Whether you agree with that thesis or not, the impact is measurable. Corporate treasuries holding Bitcoin reduce circulating supply and introduce a new category of long-term holders with multi-year time horizons.